Welcome back, everyone. We've got a brand new explainer video for you today right here on the Gap Advisors Ind AS Clinic YouTube channel. Today, we're unpacking a really fascinating accounting mystery. We're going to see how a completely normal, everyday business pivot can suddenly, and I mean literally overnight, trigger a massive hidden liability on a company's balance sheet. It's a really cool look at how Indian accounting standards actually work in the real world, specifically looking at the mechanics of Ind AS 37. So grab your notepads, because we're decoding onerous contracts and solving the 400,000 rupee dilemma. Now, before we get into the weeds, you might be sitting there wondering, why on earth should a retail investor, someone just putting their hard-earned money into shares of a listed company, why should they care about all these dense accounting standards? Well, the answer is simple. It's about protection. Understanding these applicable accounting standards is absolutely your best defense as an investor. It pulls back the curtain. It shows you how transparent a company's balance sheet really is, revealing hidden liabilities, the real costs of canceled projects, and whether the numbers you're staring at actually reflect the true economic reality of the business. By the end of this explainer, you're going to see exactly how a standard like Ind AS 87 actually acts as a protective shield for your investments. Okay, really quickly before we crack this case wide open, let's just lay down a few ground rules for our financial case studies so the numbers and timelines make perfect sense. Our functional currency and our presentation currency for this scenario is the Indian rupee. That means any currency other than the rupee is treated as a foreign currency. Make sense? And lastly, our reporting period starts on the 1st of April and wraps up on the 31st of March. Keep these baselines in the back of your mind as we go through the financial impacts today. So here's our roadmap for today. We just talked about the investor's edge. Next up, we're going to dive into the useless machine dilemma. After that, we'll break down the technical framework by decoding onerous contracts. And then we'll evaluate the actual financial impact. And finally, I'll share some really fantastic resources for expanding your gap knowledge. We've got a lot to cover, so let's just jump right in. Section 2, the useless machine dilemma. Let's look at Sun Limited's costly pivot. All right, let's dive into this. Picture a company, we'll call them Sun Limited. They enter into a very strict, legally binding agreement with another company, Moon Limited, to buy a custom-made machine. The price tag for this? A cool 400,000 rupees. But as we all know, business moves fast, right? By the end of the 2017-2018 financial year, and this is the crucial part, before the machine is even delivered, Sun Limited pivots. They completely change their production method. So suddenly, this custom machine, totally obsolete to them. They literally have zero use for it. And because it was so highly customized specifically for their old process, if they take delivery, its expected scrap value is, well, it's absolutely nil, zero. So that leaves us staring at this stark number, 400,000 rupees, which brings up a pretty dramatic accounting question. Since this asset hasn't even been delivered yet, and since it's just going to be tossed for scrap the second it arrives, does Sun Limited have to recognize a liability for this huge loss today? Or can they just kind of sweep it under the rug and ignore it until the machine actually shows up at their door? Section 3, decoding onerous contracts under the Ind AS 37 framework. Okay, so to solve this, we got to start with the basics. Paragraph 3 of Ind AS 37 introduces this concept called an executory contract. Basically, this is a contract where neither party has performed their obligations yet, or maybe both have partially performed to an equal extent. Think of a standard purchase order. You order some office supplies, but you haven't paid for them, and they haven't been delivered yet. That's a classic executory contract. Now, normally, Ind AS 37 doesn't touch these. You're not going to record a liability just because you ordered some printer paper, right? But, and this is a big but, the standard makes a very specific exception. It absolutely applies if the contract becomes what they call onerous. Now, what's really interesting here is the contrast between a normal, healthy contract and a toxic one. On the one hand, you have your standard executory contract, which is just business as usual. But on the flip side, as defined in paragraph 10 of Ind AS 37, you have an onerous contract. This is a contract where the unavoidable costs of meeting your obligations actually exceed the economic benefits you expect to get out of it. Simply put, it's a contract that is guaranteed to bleed money. And this brings us right back to Sun Limited, because this brilliantly illustrates exactly what happened to them. Let's look at their reality for a second. Their unavoidable cost, because remember, this is a binding agreement, is 400,000 rupees. And what's their expected economic benefit? Nil, zero scrap value. So the cost completely dwarfs the benefit. Because of this harsh mathematical reality, Sun Limited's standard purchase agreement has officially crossed that line. It's no longer just a purchase order. It is officially an onerous contract.
Section 4, the financial impact, recognizing the provision.
So the crucial point here is mandated right by paragraph 66 of Ind AS 37. It lays it out in black and white, saying, if an entity has a contract that is onerous, the present obligation under the contract shall be recognized and measured as a provision. That means there's no waiting around, no burying it deep in the footnotes hoping nobody notices. Sun Limited is strictly required to recognize the provision for this contract right now, today, based on that old production method commitment. Let's actually look at how this plays out as a hard accounting entry on the balance sheet. According to paragraph 68, those unavoidable costs reflect the least net cost of exiting the contract. Essentially, you look at what's cheaper, fulfilling the contract or paying the penalty to break it. Since this machine is highly customized and the contract is airtight, we have to assume the cost to exit or fulfill is the full amount. So the least net cost is the full 400,000 rupees. Sun Limited has to debit the onerous contract provision expenses account for 400,000 and credit the provision for onerous contract liability for 400,000. Bam! Just like that, the hit is taken immediately on the books, which gives investors total, absolute transparency into the real financial cost of that business pivot. Section 5. Expanding your GAAP knowledge. Let's look at some resources and next steps. Now, if you really want to dive deeper into this stuff, the issue and response we discussed today is sourced straight from the brilliant 204th edition of the GAAP Advisors Task Weekly newsletter, which is authored by C.A. Manish C. Iyer, Director of GAAP Advisors. They've actually published over 230 editions on LinkedIn so far. So if you're on LinkedIn, I highly recommend you subscribe to it. It's completely free. On top of that, this specific case is just one of over 4,500 issues and responses on Indian accounting standards and Indian GAAP hosted on gapadvisors.com. Anyone can register there for free and submit your own issues to get detailed responses delivered right to your inbox. It is an incredibly vital tool, especially for auditors who need rock-solid documentation on exactly how they addressed a specific Ind AS application out in the field. And beyond the website, here are 3 fantastic ways to stay connected and keep learning with us. First, definitely follow the GAAP Advisors Ind AS Clinic channel on WhatsApp. It is hands down the best way to get instant updates on all our videos, podcasts, newsletters, new standards issued, and new issues responded to. Second, if you're someone who loves a good audio deep dive, connect to the GAAP Advisors Ind AS Clinic podcast, available on Spotify, Amazon, or YouTube for an even deeper look into the issue we dealt with today. And finally, if you've got specific tricky Ind AS or IFRS issues you need help with, you can actually book a one-on-one consultation with the author directly through his page on topmate.io. Well, thank you so much for your time today. If you found this explainer video helpful in making sense of Ind AS 37, please hit that like button, drop your thoughts or any questions in the comments, and subscribe to the GAAP Advisors Ind AS Clinic channel if you aren't already. I also want to sincerely request that you share this video among your contacts, colleagues, audit and finance teams, and especially students who are currently pursuing their CA course. Let's all work together to spread the knowledge of Indian accounting standards far and wide. As always, I just need to mention that the views expressed in this explainer are the personal views of the author and are not binding on the audience. We kindly request that you always seek the help of a qualified expert before taking or refraining from any action based on the views we've discussed herein. I'm going to leave you with this final provocative thought. We just saw how a single 400,000 rupee unused machine forces an immediate, undeniable impact on a company's balance sheet under Ind AS 37. So it really begs the question, what other hidden onerous contracts might be lurking in the footnotes of the next company you invest in? Keep learning, keep asking the tough questions, and rely on clear accounting standards to guide you. Thanks again, and we'll catch you in the next explainer.